Stop watching the price. Watch the metal. Silver's sitting in the mid 80s looking calm while the physical market is tightening underneath. Industrial demand is accelerating. Solar, EVs, data infrastructure. At the same time, export policies are shifting and COMEX warehouse balances are grinding lower. Not one headline, not one spike, a process. And lease rates just moved. If you're holding silver, stacking it, or watching this market, what's happening right now matters more than the last 6 months of price action. If you're here now, watching signals instead of waiting for confirmation, you're ahead of the crowd that shows up after the move. We're going to teach you 2 institutional patterns you'll recognize again. We'll give you a watch list you can use tomorrow morning, and we'll reveal the one indicator that historically precedes repricing, but you won't get that until the end. Let's go. Before we dive in, if this is your first time here, subscribe. We compare notes in these comments. We don't predict. We watch structure. Here's what's happening right now. Industrial silver demand is pulling harder than it has in years. Solar panel production, EV components, data center infrastructure, all silver intensive. At the same time, certain export markets are tightening policy around silver-bearing products. Not sanctions, friction. The kind that slows cross-border flows without making headlines. Meanwhile, COMEX registered inventories, the metal actually available for delivery, have been drifting lower for months. Not collapsing, draining. And lease rates, the cost to borrow physical silver short-term, just crept higher. That's not normal during price calm. Here's the hidden layer most people miss. JPMorgan Chase is one of the largest liquidity providers in silver futures. Not a villain. A structural reality. Their positioning, how much they're long, how much they're short, shapes the flow of capital into and out of this market. And over the past several months, their net posture has quietly shifted. The price hasn't moved because the valve hasn't opened yet, but pressure is building where most people aren't looking. And if you understand the mechanisms behind that pressure, you'll see the repricing before it shows up on your screen. Not telling you to buy, showing you what to watch. Let me name this simply the warehouse drain. Here's how it works. Futures markets create liquidity. They let participants trade contracts, promises to deliver metal, without moving the physical metal itself. That liquidity delays repricing. It acts like a pressure valve. As long as enough sellers are willing to provide paper liquidity, the price can stay calm even while the underlying metal slowly leaves the warehouse. Think of it like a fire hose. The hose can spray water for hours as long as the tank is full. But if the tank is draining and no one refills it, eventually the pressure drops. The hose sputters, and everyone realizes the water was leaving the whole time. Silver futures work the same way. COMEX warehouses hold 2 categories of silver, registered and eligible. Registered metal is available for delivery against futures contracts. Eligible metal is stored there but not available for immediate delivery. It's owned by someone who hasn't made it available to the market. When industrial users need physical metal, they pull from registered. When registered runs low, eligible can be shifted over. But if both are declining, that's your tank draining. This pattern repeats across cycles. In 2020, registered silver dropped from roughly 150 million ounces to under 50 million in about 6 months. The price didn't move immediately. It stayed range-bound while the drain happened. Then in late summer, delivery stress spiked and silver ripped from $18 to $30 in weeks. Not prediction. Pattern recognition? The drain shows up before the spike. Right now, registered silver is grinding lower again, not collapsing, drifting. Roughly 60 to 65 million ounces, down from closer to 80 million earlier this year. And eligible isn't refilling it the way it normally does. That tells you the valve is open, metal is leaving, but the futures market is still providing liquidity, so the price stays calm. Circle this. Delivery months matter more than daily ticks. When a futures contract approaches delivery, holders have to decide, roll the contract forward, close it, or take physical delivery. If enough participants demand delivery and registered inventories are thin, the exchange faces settlement pressure. That's when the valve closes. That's when liquidity can't mask scarcity anymore. And that's when repricing happens. Your job isn't to predict when. It's to recognize the structure. We're watching a drain in progress. The futures market is delaying the signal, but the metal is moving. And if industrial demand accelerates while registered inventories stay thin, The next delivery month could force the market's hand, could reverse, could take months. But the pattern is active. Now let's add the second layer. Here's the second mechanism, the position flip. This one's quieter. It doesn't show up in price, it shows up in positioning data, specifically the net long or short positions held by large participants. And it matters because dominant players often shift from suppressive positioning to accumulation well before public narratives change. Let me explain. Imagine you're a major bank providing liquidity in silver futures. For years, you've been net short, selling futures contracts to provide liquidity to buyers. That positioning keeps the market orderly. It also keeps a lid on explosive moves because your sell pressure absorbs demand spikes. But at some point, fundamentals shift. Maybe industrial demand accelerates, maybe supply tightens, maybe you see stress building in delivery mechanics. When that happens, you don't wait for headlines, you flip. You start closing short positions. You start accumulating long positions. You do this quietly over months, while public sentiment is still neutral or bearish. And by the time the narrative flips, by the time analysts and media start talking about tightness, you're already positioned. The easy gains are gone. This isn't conspiracy. It's market structure. Large participants see order flow, they see delivery requests, they see lease rate movements before they're widely reported. And they adjust positioning based on that information. Not based on price, but based on the mechanics underneath price. When a dominant short starts covering and flipping long, it's a tell, not a guarantee. A tell. JPMorgan Chase is one of those participants. For years, they've been among the largest shorts in silver futures, not manipulating, providing liquidity. But over the past several months, their net positioning has shifted. They've reduced short exposure significantly. They've added long exposure in certain contract months. This isn't hidden. It's reported in the commitment of traders data released weekly, but most people don't watch it. And even fewer understand what it means. When a liquidity giant flips posture, it's not random. It suggests they're seeing something in the underlying mechanics, delivery stress, inventory tightness, demand acceleration, that justifies reducing short exposure and building long positioning. They're not reacting to price. They're reacting to structure. And they're positioning ahead of repricing, not after. Now, layer this with the warehouse drain. If registered inventories are declining and a dominant short is flipping long, you're watching two forms of pressure build simultaneously. The physical drain is real, the positioning shift is real. The price hasn't caught up because futures liquidity is still masking the tightness. But if demand accelerates and delivery stress hits during a month when that liquidity giant is no longer willing to provide short side pressure, the repricing can be violent. Not guaranteed, not imminent, but structured. Think about that. The players who shape this market don't wait for confirmation. They position during the boring phases, when everyone else is ignoring the market or waiting for the right time. And by the time the narrative flips, the easy entry is gone. The position flip precedes the narrative flip every time. Your job is to watch the mechanics, not the headlines. If you're tracking warehouse inventories and positioning data, you're in the group that sees pressure building before price confirms it. If you're waiting for analysts to call the move, you're late. Not wrong, late. Could take weeks, could take months. Could reverse if fundamentals change, but the pattern is active right now, and if you understand these mechanisms, you'll recognize them again in other markets, other cycles, other assets. We teach patterns here, not predictions. Now, here's what you need to sit with. Everyone's asking the wrong question. They're asking, when will silver break out? Wrong question. The real question is, what tells you pressure is building before price moves? Because here's the thing, price is the last signal. It's the confirmation everyone waits for. But by the time price confirms tightness, the structure has already shifted. The metal has already left the warehouse. The positioning has already flipped. The lease rates have already spiked. If you're watching price, you're always late. The real tell isn't price. It's the cost of accessing physical metal in the short-term lending market. The rate at which bullion banks and industrial users borrow silver for immediate delivery. That's your leading indicator. And it's been creeping higher while everyone's watching the spot price do nothing. We'll give you the full watch list in a minute. But first, understand the stakes. If industrial demand accelerates and warehouse inventories stay thin, the next stress point could force repricing in days, not months. If that happens while a dominant liquidity provider is reducing short exposure, there's no pressure valve. The market has to clear at a higher price. That's not hype. That's mechanics. But it could also grind sideways for months. Registered inventories could stabilize, lease rates could normalize, the position flip could pause or reverse. We don't know timing, we know structure. And structure is flashing stress right now. Let's equip you. Here are three paths this could take. First path is the grind. Registered inventories stabilize around current levels. Lease rates tick higher, but don't spike. Industrial demand grows steadily without acceleration. The position flip completes quietly over 3 to 6 months. Price chops in a range, frustrating both bulls and bears. No drama, no headlines. Just a slow reset higher over quarters, not weeks. This is the boring path. It's also the most likely. Second path is the stress pop. Delivery stress hits during a front-month contract while registered inventories are thin and lease rates spike. The market can't roll smoothly. Settlement pressure forces repricing in a compressed window. Silver jumps 10 to 20% in days, pulls back, consolidates, then grinds higher over months. This is the volatile path. It happens when mechanics collide with tight timing. Not predictable, but recognizable when the signals align. Third path is the policy shock. Export restrictions tighten further, or a major industrial buyer announces supply constraints. The narrative flips overnight. Media covers it. Retail rushes in. Silver gaps higher and stays elevated because the fundamental story changed, not just the technical setup. This is the headline path. It's rare, but when it happens, it's fast. Who benefits in each path? Traders need volatility, path 2 and 3. Holders need patience. Path 1 still works if fundamentals are right. Stackers care about physical availability, not price. Watch premiums, not charts. No guarantees, just frameworks. Now here's what I'm tracking. First thing is COMEX registered inventory. Normally you see slow drift plus or minus 2 to 5 million ounces per month and eligible refills as registered depletes. Under stress, you see step downs of 5 million ounces or more in a week, and eligible stays flat or declines right along with registered. Why it matters. When registered drops fast and eligible doesn't replace it, the physical buffer is shrinking. That's your tank draining. Second is silver lease rates, specifically the 1 to 3 month window. Normally, these are near zero or slightly negative, indicating abundant borrowing supply. Under stress, you see positive rates that climb toward 1 to 3%, or sudden inversions where short-term rates exceed long-term rates. Why it matters. Lease rates reflect the cost of borrowing physical silver. When they spike, it means someone needs metal now and can't wait. That's your leading indicator. Liquidity delays truth until delivery demands it. Third is retail premiums on coins and bars over spot. Normally, you're looking at $2 to $4 over spot, compressing during weak demand. Under stress, you see $5 to $8 or more sustained for weeks, or widening while spot is flat. Why it matters. Retail premiums tell you if physical supply is tight at the last mile. If premiums stay elevated while spot is calm, the disconnect is real. The physical market is already repricing. Futures just haven't caught up. Fourth is front-month open interest into delivery. Normally, you see smooth rollover. 80 to 90% of contracts roll forward, minimal delivery requests. Under stress, open interest stays high into the last week. Delivery notices surge or settlement delays get reported. Why it matters. When participants demand delivery instead of rolling contracts, it forces the exchange to produce metal. If registered inventories are thin, that's your pressure point. Fifth is China-linked export and customs updates. Normally, you see routine trade flow, no policy changes. Under stress, you see new restrictions on silver-bearing electronics, rare earth processing shifts, or commentary from Chinese industrial buyers about supply tightness. Why it matters. China is both a major producer and consumer. Any policy change that restricts outflows or accelerates inflows moves global balances. Watch for actionable constraints, not noise. Here's how to interpret this. Confirmation happens when at least 3 of these 5 signals move into stress territory within the same month. That's your cluster. That's when the drain and the flip are converging. Falsification happens when registered inventories refill from eligible, lease rates normalize, and premiums compress. If that happens, the pressure isn't building, it's releasing. Don't force the trade. And here's your risk cluster. Diversify your signals. Don't stake conviction on one metric. Watch multiple time windows, daily lease rates, weekly inventories, monthly open interest. Use multiple sources, COMEX reports, bullion dealer websites, futures broker data. Track both leading indicators like lease rates and confirming indicators like price and premiums. Accept that timing is uncertain. Structure can be right for months before price moves. Your job is to understand the setup, not predict the day. If you're a trader, respect volatility. If you're a holder, accept pullbacks. If you're stacking, know what you own and why, not advice. Pattern recognition. If you track these 5 signals, you're in the group that sees pressure before price confirms it. You're not waiting for headlines. You're not chasing breakouts. You're watching the mechanics that precede repricing. And when the crowd shows up late, when analysts finally call the move, you're already positioned. Not because you got lucky, because you understood structure. Pressure shows before price. The warehouse drain and the position flip are patterns you'll see again, not just in silver. In any market where futures liquidity can temporarily mask physical tightness, copper, platinum, even agricultural commodities. The mechanics repeat because human behavior repeats. Institutions position early, retail reacts late, and the fundamentals always win, eventually. Could reverse, could take months, could grind sideways and frustrate everyone. But if you stay disciplined and watch the signals instead of the noise, you put yourself in the group that doesn't get shaken out by volatility. We don't predict here. We watch, we compare notes, we teach patterns so you can recognize them yourself. So tell me in the comments, what signal are you tracking this week? Inventories, lease rates, premiums, or something else entirely? Let's build the watch list together. And if this helped you see something you weren't watching before, subscribe. We do this every week, different markets. Same approach, structure over speculation. One last thing, watch the metal, not the headline. The players who move markets don't wait for confirmation. They position during the boring phases. They watch ignored signals. And they understand that liquidity delays truth until delivery demands it. You're ahead of the crowd just by being here. Now go track those signals.